This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. I will be your host today for the next hour. My name is Luke Guerrero, and today is Friday, June 28th, 2024, which means we all made it through the week and we all made it through the month of June. Now, certainly the first half of this year has brought us a mixture of interesting news, wars persisting in regions of the world, supply chains shifting, inflation moving lower, and a job market that has remained uncharacteristically strong. And through all this, we come here to this program day after day and become better and more informed investors. Now, how do we do that? Well, we give you educational actionable items, things that help you look in the mirror and look into your portfolio and say, can I do better? But truly, the best way to figure out if you can do better is to call in or leave us a comment on our YouTube or leave us a review on iTunes and ask your finance and investment questions, because that, honestly, is what I prefer to answer every time I'm with you. Now, with that being said, we'll run down what happened in the market today and this week, as well as run down those show topics. But first, why don't we get to our first question?
Good afternoon, Justin and Luke. This is Steve from Colorado, and I'm just calling if I could get your assessment on Dow Incorporated, ticker symbol DOW. It is a stock that I have a small position in, and I'm concerned about whether the company can continue to pay its dividend. So I appreciate your assessment and whether you think I should continue to add to it or consider selling. Thank you.
Well, Steve, taking a look at Dow, that's Dow Inc. It's a material sciences company, very, very large material sciences company, almost $40 billion in market cap. And they do pay a pretty significant dividend. Now, they didn't pay one in 2019 when they first spun off, but they had a 5% dividend and then 4.9% in 2021. So they pay anywhere between a 5 and 6% dividend typically. Now, that dividend started out at $2.10 and it grew to $2.80. This year, it's projected to be $2.85 per share. But I think when you consider owning a stock for its dividend, you have to understand that a dividend is nothing more than you getting immediate return for holding a company, right? Mathematically speaking, when a dividend is paid out, that's cash that's coming out of a company, and the stock price adjusts accordingly. So rather than focusing on the long-term gain of the company, you're getting the immediate distribution. But you also should be thinking about, well, what about the business? Sure, they could pay you a $2.90 dividend. They could pay you a $6 per share dividend. But if the stock falls or the stock doesn't keep up to pace, which is the more likely risk, right, for any company, keeping up to pace with it's called the opportunity cost, well, then you end up worse off than holding a stock that maybe had a lower dividend. But anyway, so let's take a look at this company. Because the first thing that alarms me is revenue. They made $60 billion in revenue in 2018, and now they're at $44 billion. The revenue's fallen, which, that's the top line. What does the bottom line look like? Well, profitability has fallen as well. Their net margins in the 7 range. They peaked out in 2021 at 11.4, 1.3 last year, projected to be 4.7 this year. Cash flow has been falling off a little bit. And so at the same time, they're also not really paying down their debt much at all. I see they just had 3 new bond issuances recently. And so when you ask me, can they continue to pay out their dividend? Maybe. Their balance sheet looks like it's getting more and more stretched, but likely they'll still be able to pay out that dividend. But you should be looking for not dividend payers, but dividend growers and companies that can capture consistent growth. Where it's priced at right now, its revenue growth over the past 3 years, its margin compression. I just think there are better opportunities that do pay similar, maybe even a little bit lower dividends. So I would honestly not put any more money into this company. I think there are better opportunities out there. Thanks for the call. Now, we got a lot of ground to cover in the next 45 minutes or so. And here's what we have planned for you, time permitting. My main focus point concerns this question. We talked a little bit about it earlier in the week, and that is why Buffett is fueling up on energy stocks. Warren Buffett, the legendary value investor, of course, is making waves with his massive bet on blue chip energy stocks like Occidental. We answered a caller question about that on Wednesday. So we're going to talk about some of the key factors behind this investing legend's bullish stance on the energy sector. Also, we're going to talk a little bit about American stocks and how they are representing an even larger proportion of the global stock market than they have in quite some time. Is that bad? Is that good? What does that mean for you? We'll also talk a little bit about coal and how some might be dubbing it the new gold. What does that mean? Well, we will get into that. And should we have time at the end of the show, we'll touch on the PCE figures and the expectations of interest rate cuts. Does it mean anything, or is it just noisy? We also have some voice bank questions that are ready to play, and some questions that came in earlier to the comments section of our YouTube channel. And of course, anytime you want to do it, pick up that phone, dial that number, 888-99-CHART. I would love to hear from you live. Now we're going into a short break, and on the other side, we'll talk about today's market activity. Please remember, you can call anytime and leave your questions on the InvestTalk voice bank. If you are listening via our live stream or on AM 1220 radio in the Silicon Valley area, call now. 888-99-CHART.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast.
Now, before we get to the market today, let's go to Chris in Florida, who has a question about Lululemon. Do you own it, or are you looking to buy it?
I currently own it, and was just curious if you thought that I should buy some more on the weakness that we've been seeing lately with it, if I should hold it or if I should just get rid of it.
Yeah, of course. So, the weakness that came in today is likely due to Nike's forward-looking guidance. Certainly, Nike took a little bit of a hit on its earnings and its forward-looking guidance. And so that kind of spells some trouble for similar businesses, right? Lululemon is a athletic, athleisure, if you will, kind of a luxury level athletic brand that sells a bunch of sports clothing, workout clothing. I think they even dabble a little bit in work clothes as well. So there's a whole range of clothing. And so over the past year, it's been pretty weak, down 20%, down 41% year to date. But at the same time, revenue growth has been pretty consistent. And pretty good, 23% over the past 5 years. Really the bulk of that, though, being pre-pandemic, and then it kind of tapers off a little bit. Now, their net margins have been increasing, and their cash flow has been increasing with their revenue as well. And for a $38 billion company, they have pretty, a little debt, but not much at all, $1.4 billion. And so earnings have been upgraded recently. I would be interested to see how analysts adjust earnings given what's going on in the retail market going forward and what we've learned this week, not just from Nike, but from Walmart as well. And so, when I think about Lululemon, I think one of the reasons why it's down is something I talked about a couple weeks back when someone called about Lululemon, and that is the advantage that it had originally has kind of been eroding. You have other brands like Rhone, you have brands like Tencent, like Viore, and all these brands that pushed a lot of social media marketing and started to chip away at Lululemon's hold of this kind of niche area of athletic clothing. And so, I think probably the best growing days of Lululemon are behind it. You will probably see a little bit of a pop as people are more confident that consumers' purchasing power isn't degrading as much as maybe some of these companies would suggest. I certainly wouldn't sell it yet. I would probably hold on to it, but it could be the case, and I wouldn't be surprised if you see a little bit more of a move downward as some of these other companies within the same line of business come in and also reinforce the weakness that was suggested by these apparel companies. So I would hold on to it for now. I don't think it's necessary to dump it at this moment, but certainly I wouldn't buy more right now.
Thank you.
Thanks for the call, Chris. Now, shifting gears, let's talk about the market. U.S. stocks mostly lower. The Dow down 12 basis points. S&P 500 large caps down 41. Tech underperforming that, down 71. Russell 2000 small caps actually up today. There's been some divergence recently between how small caps and how large caps have performed. So it's not at all surprising to me. Overall, I think trading was pretty quiet today, though. Afternoon weakness, maybe even a function of quarter end flows. As you recall, not just the month is over, but the first half of the year as well. Major indices logged kind of a mixed performance. The equal weight, a notable laggard on the day. Big tech was lower, though several names are still up solidly on the week. Overall, the underperformers included apparel companies, as I mentioned, apparel retailers, some insurers. Outperformers looks like small caps, as I mentioned. Banks, credit cards, semis, energy did well. Notably, May core PCE inflation was in line with the consensus. April revised slightly upward as well. The annual rate down to 2.6% from 2.8%, and now the lowest since March of 2021. There's also a final read given on the June University of Michigan's consumer sentiment, which improved as well. Notably on the corporate side, Nike, as I mentioned already, came under pressure after it missed on its fiscal Q4 sales and slashed its guidance for fiscal year 2025. Takeaways focused primarily on the softness in lifestyle products and digital, along with really China's underperformance and their underperformance in that market. So, as I mentioned to Chris, we should really look ahead to if other companies follow through with poor forward-looking guidance and what that says about the industry as a whole. Bullish talking points for the week. What happened for the bulls? May core PCE inflation, of course, coming in in line with expectations. Amazon hitting new all-time highs with their market cap pushing above $2 trillion on the back of positive sell-side commentary. FedEx rallied, which bodes well for freight. Carnival beat and actually raised, which really is a boon to the idea that consumers can still spend. On the bearish side, more dense in the resilience theme with the weakness of retailers. Walmart said Q2 will be the most challenging quarter from a comps perspective. Airbus profits are waning and continuing claims hit the highest levels since November of 2021. And as has been the problem for several weeks now, market breadth, as in how many stocks are being carried in an upward rally, still remains pretty wide. Looking forward to next week and really even, I guess, next month, because next Monday is July 1st. ISM Manufacturing is coming in on Monday, JOLTS survey on Tuesday, Fed minutes coming in on Wednesday, and payrolls on Friday. Now, I hope you've been telling your friends that we are available in video format on our InvestTalk YouTube channel. That's InvestTalk with 2 T's. And if you go over and you watch our videos and you leave some comments with some questions, we will answer them. This question came in from Matthew Bird on healthcare investing. It says, I was wondering if you could talk about healthcare investing. The space has been difficult with rising utilization hurting the managed care companies, fear of GLP-1s hurting medical devices, also higher interest rates, and the life sciences getting hurt by decreased biotech spending and difficulty in China. But the demographic tailwinds are in favor of many healthcare companies, and not just Eli Lilly. Would you view this period of healthcare malaise as a time to accumulate high-quality names within the sector? What are your thoughts? Well, I think you hit on a lot of some issues, right? There's some uncertainty about the effects of GLP-1s, what that does for the overall utilization of healthcare within the United States. And bottom line numbers have been hurt by managed care sectors. But for me, I think the way you make the most money in investing is being a contrarian. And as you mentioned, you're on the right track. Demographics are on the side for the long term, these healthcare companies growing. Rather, their revenues growing. So I think that the biggest risk in the market is not being exposed to every individual sector. And as healthcare prices have fallen and they've been underperforming, I think now is certainly a good time to pick up good names. This is InvestTalk now with over 59 million downloads, and that is all thanks to you. I'm Lou Guerrero, and our work continues after this break, so get your questions in now at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Thanks for watching, and don't forget to like and subscribe and turn your notifications on because you don't want to miss a single episode of the InvestTalk podcast.
Now, my main focus point concerns this story: why Buffett is fueling up on energy stocks. So let's talk a little bit about Warren Buffett, blue chip energy stocks, the energy sector, and why it's not really just him that has been purchasing several names. Now, in June, legendary and renowned investor Warren Buffett, I think you all know who he is, through his company Berkshire Hathaway, made significant investments in energy stocks. He purchased around $434.8 million worth of shares in Occidental Petroleum. We had a caller question about that name on Wednesday. Similarly, Carlos Slim's company invested almost $80 million in PBF Energy. And so it appears that there is growing interest among savvy investors in the energy sector. So why may this be the case? On a company level, Occidental Petroleum's strong position in the oil and gas industry, especially in the Permian Basin, and its strides in reducing its debt from 2019 till now. It's reduced its debt in half, as well as leveraging high oil prices to improve its financial health. All items I mentioned when answering the call on Wednesday certainly makes it attractive. PBF Energy is a similar story, with strengthening their balance sheet as well. But there are also reasons why the industry as a whole has become attractive. The first, recession concerns. Recent economic worries have really driven down energy stock prices because they assumed demand would be driven down. And so that makes some of these valuations pretty attractive. Another is OPEC's influence. They're likely to continue to manage the supply effectively to support these oil prices, and that should really benefit the overall energy market. AI is another important aspect of this. Not that artificial intelligence will improve the way businesses are run within the energy space, but that they have high demands for electricity. And so these companies' revenues should certainly go up to meet these demands. Diversification needs is another reason. There's been a lot of market-wide concentration within the tech space. And so for portfolios that are overinvested in tech and with energy stocks at pretty attractive valuations, the sector is a compelling option for diversification. Another reason, strong demand for natural gas. Forecasts show natural gas prices remaining well above $3 per 1,000 cubic feet. So the potential for price rises next year means that some investors are tilting towards natural gas names, bolstering those companies involved in natural gas production. Overall, this thinking is pretty in line with what we've been saying for some time. Given the current market environment and success of growth names over the past year and a half, current dynamics are favoring a shift towards the less often thought about, but supremely important energy sector. Let's get another caller question right now.
Hey, Justin and Luke. This is Tim from Michigan. Question, I currently own XLE, Exxon, and ConocoPhillips in that energy sector, and I'm looking to purchase some Oxy, OXY. And I'm curious as to whether I should add Oxy to those positions or if I should replace one of those positions with Oxy. And obviously, this is all assuming that I'm not over the appropriate percentage for that sector or any one of those stocks. Thank you.
Yeah, well, I'm going to make the assumption that you are exactly at the weight you want to be for the energy sector, right? I think that it is important when constructing a portfolio to have what you would call tolerance bands, where you don't want to go more than X amount overweight or more than X amount underweight, some reference, right? I like to use the reference of what the overall market is. And that is a way to deal with one of the forms of risk, tracking error, because wealth creation and returns are all references, right? It's all relative rather to the overall market, because it's how much are you returning relative to how much everybody else is returning, because spending power in nominal dollar terms diminishes over time. And so with that in mind, I would say, assuming that you are where you want to be within energy, I think it makes sense to sell out of XLE, the more broad-based energy stock or energy ETF, and buy into Oxy. And so your overall weight within the energy sector would remain the same, but you're in essence tilting towards a company that you believe has the opportunity to have higher expected returns than the index overall. Thanks for the call. Now let's see if we can get another caller question in now.
I want to thank you guys for all the research you guys do. I was looking to start a position in either Devon or Blackstone Minerals. I was hoping to get your guys' advice on the stronger company. Thank you in advance. Bye.
So the question here is about Devon Energy, I believe, and Blackstone Minerals. So let's start with Blackstone Minerals, and we may not have time to answer this whole question before we go to the break, but we'll get started. So Blackstone Minerals is an exploration company. It looks like 57.5% of their total revenue comes from their oil business. About 40% of their revenue comes from their natural gas business. Now, in terms of revenue growth, they've actually fallen over the past 5 years, about $594 million in 2018. That's down to $500 million this year, projected to be $493 million last year. From a relative valuation perspective, it's pretty cheap. They're trading at, well, on a price to earnings basis, it looks pretty cheap, 10 times, but price to book is around 3.8 times, which is pretty high relative to the industry average. Now we'll get more into Blackstone Minerals and talk about Devon as well when we get back from the break. On the next Invest Talk, we'll also look into the story behind this headline: the CRE crisis, banks unloading office loans. The commercial real estate market is in turmoil as banks rush to sell off billions in office loans. We dive deep into the unfolding CRE crisis, examining its causes and potential consequences for the broader economy. That's Monday, but for now, I'm Luke Guerrero, and we are ready to take your calls live at 888-99-CHART.
Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Now, before we headed to the break, we were looking at Blackstone Minerals, and what I mentioned was that they had falling revenues, their profitability didn't look great, and a couple other things I didn't mention is that their dividend yield was sky high and their cash flow was falling. And so the question was about Blackstone Minerals versus Devon Energy. So Devon Energy is a oil and natural gas exploration company, 58% from oil, about 8% from natural gas. Now their revenue growth is a different story. 8.4% annualized over the past 5 years. Now obviously that's going to take a dip after 2022. That was a record year in terms of revenue, but still growth is on the right track. Cash flow is also a different story. Their cash flow peaked out again 2022, but didn't have as steep a drop off heading into 2023. Profitability also not having as steep a drop-off heading into 2023. Now, both of these companies' revenues, profits are going to be predicated upon the price of the underlying commodities. We know this. But overall, if you have to pick between a company that's got a 10% dividend yield that does not have sustained growth over a 5-year period versus a company that has a lower dividend yield of 4.36%, whose payout ratio is only 41%, which means that they aren't at risk of lowering their dividend in the near term, his revenues are growing, his cash flow is growing, his profit margins look growing, I'm going to go with that one, which is Devon Energy. Thanks for the call. Now, I want to briefly mention that the newest KPP Premium Newsletter, which will be distributed to subscribers tomorrow. This week in the KPP Insight section, we talk about inflation. And I don't mean what the inflation number is. I mean, what do they mean? What is PPI? What is CPI? What is PCE? How do they differ? Which one does the Fed care about? Which one should you care about? In the stock ideas section, we mentioned an animal health company and a technology company. And in the portfolio management section, we touched on several variables to use when analyzing a stock. If you're interested in learning more, visit us at investtalk.com and subscribe. The newsletter will come to your inbox on Saturday mornings. Now let's shift gears and talk about something that maybe hasn't been talked about enough, and that is how much of the global market is dominated by American stocks. Now, 16 years ago, the landscape of the global stock market was markedly different from today. Back in the early 2000s, while the American markets struggled, European and emerging market equities surged. By March of 2008, the US was in a recession, triggering a global financial crisis. And now, at the time, American stocks comprised about 40% of the global stock market. Well, today, that number is 61%, more than 50% increase. So the significant shift in market concentration is not just a broader economic story, but also a tale of extreme dominance within the US market itself. Currently, 3 companies, Apple, Microsoft, Nvidia, constitute about a tenth of the global market's total value. Nvidia's recent market performance illustrates the potential volatility associated with such concentration. When it dropped 13%, the entire MSCI All Country World Index dropped 50 basis points. Now, historically, market concentration has been a mixed signal. During the late 90s, dot-com bubble, the 10 largest US stocks represented about a third of the domestic market cap, mirroring today's figures. Before Japan's asset bubble burst at the end of 1989, Japanese stocks were 40% of the global market. Now, it's not always bad, because on the contrary, the 1950s and the early 60s, the US market was similarly dominant. Major firms like AT&T, Exxon, General Motors, they really led the charge without any adverse effects. So the question has to be asked, which is it? Should we worry? Are we okay? Well, while valuations like Nvidia's price to earnings of 43 suggest high expectations, to say the least, they're pretty far away still from the extremes of past bubbles like Cisco's was in 2000 or the overall Japanese market was in 89. And the primary driver of the US's current position, earnings growth. Since March of 2008, earnings per share in the MSCI US index have increased 162%. On a global level, if you look at the globe minus US stocks, earnings have declined. Exclude tech, and America is still 55% of the global market. Now, market concentration can be a cause for caution, but often it reflects the underlying economic strength. And that's the case in the US. It's the ability of the American companies to innovate, grow, deliver profits that have really driven their outsized impact on global markets. But even with this in mind, keep in mind, it doesn't mean there aren't opportunities to be abroad, and certainly we still recommend that you get exposure to different markets around the world. Now let's pivot back to the InvestTalk voice bank and play a question that came in earlier.
Hello, Justin and Luke. This is David from San Jose. I was calling to get your opinion on a couple of ETFs, which one you thought was better. Looking at the Vanguard VTI and the Vanguard VUG. Look forward to your answer. Thank you for everything. Bye.
Okay, David, let's take a look. So VTI is the Vanguard Total Market ETF, Total Stock Market ETF, that is. And essentially what this fund does is it looks at US listed stocks of companies with at least a $15 million market cap, so pretty micro, and just market cap weights them. So you will get the return of the US market, right? It's like similar to the Russell 3000, but it goes smaller. And so you're going to get, like I said, exactly the market-like return, nothing more, nothing less. And it's a pretty easy fund to manage because if you own every stock, right, it self-rebalances because as some grow, some shrink, the weight remains exactly the same. That's why Vanguard delivers this at 3 basis points. Now, taking a look at VUG, that is a different fund. That's a Vanguard Growth ETF. And the Vanguard Growth ETF is a little bit more expensive. Mathematically, it's 33% more expensive, but it's 4 basis points. And it's a passively managed fund that looks at 6 growth factors that include earnings per share, 3-year annualized earnings per share, historical earnings per share growth, and other composites of growth, and then creates a portfolio that takes on the large cap growth space. Now, we know that large cap growth names have done particularly well in the past couple years. And so with the largest weights in this name being the three names that I mentioned before, Microsoft, Apple, NVIDIA, certainly this fund has been doing pretty well. It's 1 year return, 36%. Compared to the MSCI USA Large Cap Growth Index, which is actually only... Well, actually, it underperformed the index, so that's worrisome right there. So maybe the construction of this portfolio is not great to actually targeting the growth side of the market. That's something else to get into. But I think the bottom line comes to understanding what the funds are doing. And so when you say what is better, the total market ETF or the growth ETF, I would counter by saying you can't say better because they're different. Right? If you want to just get US market exposure, no tilts at all whatsoever, that is VTI. If you think that you want to get heavier tech exposure than you otherwise would get, right? This one is 62% tech. Then this is the fund you're going to want to be in. Now, historically speaking, value names have still outperformed over the long term. And that's because much of owning a stock is about when you buy it and when you sell it, right? And so although the past couple years and recency bias may tell you that the large growth side of the market is going to outperform, it may continue in the short term. I still expect in the long term those undervalued names that have high profitability, maybe even smaller, are going to outperform. So, I think that overall having 60+% exposure to the tech sector is a little bit dangerous for all the reasons I mentioned in terms of creating those bands and those sector exposures. So frankly, if you want to keep this as a very small portion of your portfolio, I'm fine with that. I wouldn't keep it as a large portion of your portfolio. I don't think you ever want to be over 60% invested in any individual sector. So know the differences, know why you would own each. It's okay to have a little bit of this, but I certainly wouldn't go overboard. Thanks for the call. Now on Fridays, we generally try to fit in a quick rundown of key benchmark numbers. So let me hit that list for you now. The 2-year Treasury yield was at 4.747%. For context, 2 weeks ago, it was 4.69. More than 2 years back, it was 0.64. The 10-year Treasury yield was at 4.388%. Last week, it was at 4.259. More than 2 years ago, it was at 1.762. Gold was priced at $2,325 per ounce. Last week, that number was $23.17. 22 weeks back, it was at $20.18. And 103 weeks ago, that was $18.09. Silver today was priced at $29.14 per ounce. About a month back, that was $30.37. About 20 weeks back, it was $22.80. And 115 weeks ago, that was $23.94. Oil was selling for $81.51 per barrel today. 2 weeks back, that number was $78.16. 10 weeks back, it was $83.10. And 112 weeks back, that was $97. National average for a gallon of regular gasoline is $3.50 per gallon. Last week, that number was $3.45. 5 weeks ago, $3.60. 104 weeks ago, $4.25. In California, it was averaging $4.80 per gallon today, down a whopping 1 cent from last week. For comparison, in Mississippi today, gas was averaging $2.94 per gallon. That is $1.86 less per gallon than gas in California. Now, speaking of energy, speaking of gas, speaking of coal, I want to talk a little bit about how, from certain perspectives, thermal coal, deemed the world's most polluting fuel, seems to be on a downward trajectory. Now, current prices have dipped slightly. In China, the world's largest consumer of coal, faces economic challenges that have boosted its hydropower production and really diminished its overall reliance on the dirty rock. In a recent initiative to combat climate change, G7 nations resolved to phase out the unabated coal power by 2035. Yet, despite recent price reductions from the highs of 2022, triggered by the Russian-European energy crisis, war in Ukraine, coal prices have stabilized. And not only have they stabilized, they've stabilized at levels higher than those before the conflict in Ukraine even started, even adjusting for inflation. Now, unlike many commodities that have been volatile due to economic instability, war, weather changes, the coal market's been pretty calm. And so this stability has even led some to question whether coal could be considered a reliable commodity investment akin to gold. Because despite higher interest rates, strong dollar, sluggish growth in China, the cooling global economy, the coal market has shown surprising resilience. And in order to understand why this could be the case, you have to look at the supply side. Now, on the supply side, Germany recently shut down 15 coal power plants in a single weekend. China is rapidly expanding its solar and wind energy capacities to decrease pollution. So maybe the reason for this stability is a simple economics 101 supply and demand story. Looking forward, while the demand for coal is expected to eventually decline globally, its allure for investors might not wane as swiftly, primarily because the supply is likely to decrease even more rapidly than the demand. And so, unlike previous cycles, where high prices prompted extensive mining investments, right? Because if coal is expensive, you want to capture that. You would open more mines. The recent high price points have not led to a similar surge in new mining activities because investment in coal mining is dwindling. Financial institutions are pretty hesitant to fund new mining projects. So, as coal supply decreases more rapidly than demand, the market could witness price spikes, alternating with declines, and then more spikes, and then more declines, mirroring a more speculative investment landscape. So despite its diminishing role in global energy profiles, given the entrance of what could be a new era of coal, private equity is already looking at it, coal's impact on investment portfolios and the broader economic landscape is certainly poised to remain significant for some time. Now, before we head into the break, let's see if we can fit in or at least start one caller question now.
I'm calling, asking a follow-up question from another listener. They were talking about small cap ETFs. My question is just, how do those work exactly? If over time small cap and value do grow, do they just recycle out small cap companies with other small cap companies? Like, how does the value actually go up on these funds? And so I'm just trying to figure out how these work. Thanks for all your guys' help, and I'll listen on the show.
Yeah, so the question about small cap ETFs, that is exactly how they work. And so when you think about a passive fund versus an active fund, right? A passive fund tracks an index, okay? And an active fund is free to rebalance as it sees fit. And so within the small cap and value space, where you have what's called rotation, you see small cap stocks that appreciate, they become mid cap stocks, they no longer belong in that fund. Value stocks move more towards the growthier space, right? They appreciate in value, so their relative prices are going up. And so, yeah, you want to divest from them as a fund, right? They're no longer exhibiting those characteristics. And so that's where the difference between passive and active comes into play here. Because if you're tracking an index that rebalances once a year, you rebalance once a year. So if your small cap becomes not a small cap, you still hold on to it. That's what we call style drift. And so for me, when you're targeting these specific areas of the market, these sub areas of the market, I think that is exactly where active management comes into play, right? If you held GameStop in a Russell 2000 small cap tracking ETF back in 2001, you held it all the way through the up and then all the way through the down. If it was through an active fund, they could sell the top. And so when you're targeting these smaller areas, I think it's best to move towards the active side. But yes, you are correct. That is how these small cap and value ETFs work. Now, this is InvestTalk, and I'm Luke Guerrero, and we have one goal here, and that's our same goal each and every day, to help you achieve your financial freedom. Our work continues after this break, so get your caller questions in now because it is our final break in the month of June.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
I'm calling about a stock. It's SPGI, S&P Global. It looks still overvalued to me, and I was trying to get your thoughts on it. But it looks like they recently issued more shares, and they also took on more debt to make a purchase. Again, still looks overvalued. So I don't like to short stocks, but a good company to sell credit spreads on. Overall, I think it's a good company. Just running into some headwinds like Justin talks about is that they make money by people indexing, and in the future, if the indexing is lower, then they might decrease their earnings. I would like to buy it in the future at some point, and I'm wondering what your thoughts are on it as a company and what might be a good purchase price in the long term. And then in the short term, is it a good stock to sell their credit spreads on? I appreciate your thoughts. Thank you.
Yeah, so taking a look at S&P Global, they are a index provider and construction company. They do independent ratings. I think you all know about this company. And over the past 5 years, growth has been pretty good, about 14.8% year over year. Their net margins are, as most net margins within this industry tend to be, fantastic. They peaked out in 2021 at about 38%. They dipped down to 21% last year, projected to be 33% this year. Cash flow since about 2019 has certainly improved. It dipped a little bit going into 2022, but it looks a little better. Relative strength fallen off, but it's been pretty stable overall. On a 5-year basis, it's actually outperformed the S&P 500 by about 10%, which is pretty solid. And so part of this question was about relative valuation. So forward-looking PE 29 times is about where it's been for quite some time. The reason why? Margins are fantastic, and operating costs are pretty low. Price to book about 4 times is actually better than it's looked for some time. Now, you said they issued shares recently. I don't see that within my data set. I see they issued shares in 2022, but that's really the only time in the past 5 years I think they've issued shares. So I wouldn't call them a serial issuer of shares. That's not a problem. Now, they may have issued some debt, about $1 billion, not like $500 million in the past year. But I mean, their debt levels are still modest. I mean, they have 11, almost 12 billion in debt on a $141 billion company. And so, yeah, that matters in terms of their financing levels. But at the same time, they're also at a 13 times interest coverage ratio. So their interest before earnings and taxes can cover their debt financing 13 times over. So would I sell credit spreads? No. And I think one of the benefits of a company like S&P and why it trades at such high premiums is they don't have a lot of assets to service. You don't need to service it, not within this business. There's a really high switching cost if you're a fund that is either tracking this index or benchmarked to this index. It's another reason why Russell does so well, right? Why FTSE Russell, FTSE Russell does so well is because a lot of funds that benchmark to this, they're not going to change. It is incredibly expensive to sticker a prospectus. So, this may actually be one of the times where I'm okay with a stock that is this expensive. Again, not all price to earnings, not all PDEs are the same. Price to sales is 11, again, pretty high, but where it's been over the past 5 years. And so it's a very well-run business. It may be a little overvalued. I don't think it's that much overvalued. I think they have a lot of room to grow as they continue to grow, right? Because I don't know what their asset structure is like, or rather what their fee structure is like. I don't know if it's just a blanket fee per fund, or if it's an asset-based fee. I would have to look more into that. But overall, if a company's got a 13, 14 times interest coverage ratio, I don't think you want to make bets that debt is going to be a problem there. Thanks for the call. Now, before we head off to the weekend, I just wanted to briefly mention that with PCE coming in line, again, the Fed's preferred measure of inflation, what you're probably bound to see over the next couple weeks is speculation that interest rate cuts are imminent. And I want to remind you, as I like to remind you, that earlier in the year we were going to have 7. By March, we were going to have 3. Then we were going to have 1. And the Fed has been pretty consistent all throughout. So as people come to you and people say, we're going to cut rates, I would say, as has always been the case, listen to the Fed, don't fight the Fed. Now, I'm Luke Guerrero, and this completes another episode of InvestTalk. Justin and I want to thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, and please be sure to review and rate us on iTunes. Also, come over to our InvestTalk YouTube channel, InvestTalk with 2 T's, and check it out. Look at the charts we look at. See what we look like. I've grown a beard recently. Maybe you like it, maybe you don't. Let me know in the comments. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.